We're going to go back in time today to the very recent past, just a couple of years ago. January 10th, 2008. Imagine the scene. Washington, D.C. You're at the Women in Housing and Finance and Exchequer Club joint luncheon. And the honored guest, the keynote speaker of the day, is Mr. Ben Bernanke, chairman of the Federal Reserve at the time. So bear in mind the date, January 10th, 2008, just 9 months before Lehman collapsed, before the entire world plunged into economic chaos, financial crisis, trillion-dollar bailouts, stock market swooning up and down thousands of points in a day. The chairman of the Federal Reserve, in response to questions, he gave his prepared remarks, and somebody asked a question about whether or not the Fed is predicting a recession. He said very succinctly, the Federal Reserve is currently not forecasting a recession. This was just 9 months. 9 months before the Great Recession began. And they didn't see it coming at all. Bear in mind, Mr. Bernanke, a couple of years before, when he was on the Council of Economic Advisors, in response to a question about housing prices had gone up and up and up and up and up, and somebody asked him a question, hey, is this sustainable? Is this going to cause a problem to the broader economy? And he said no. He said it's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis. Bernanke said that housing prices might slow consumption spending a bit, but I don't think it's going to drive the economy too far from its full employment path. In other words, housing prices won't. He said, there was so many times when he went in front of Congress and said, I don't think this is going to bleed over to the broader economy and everything's going to be fine. And look, I'm not trying to pick on Ben Bernanke. He's just one person. This isn't about individuals. I'm not trying to attack any single individual. But the point is that predictions are hard, especially about the future. And the system that we live in is where we take a tiny cadre of high priests, economic high priests, we put them in a little room and we award them totalitarian control over the money supply, which is the greatest control you could ever have over an economy. You can have an absolute stranglehold over the economy by setting the price of money. Setting the price of money, basically, the price of money is interest rates. That's where supply and demand for money are supposed to meet. Interest rates are the price of money. And when you control the price of money, you control the price of everything. You control the prices of homes. You control whether or not consumers are able to get a car loan, or whether or not they're able to go and charge up their credit cards for a new flat screen TV, or whether or not they're able to book that trip to Europe on their credit card, or what the price of flats are in Hong Kong, or whether a manufacturer is able to get a loan for a new piece of machinery to fulfill that order to the Chinese, or whether or not Apple is able to go out into the marketplace and at what price they're able to sell bonds to investors and raise additional capital to expand their operations. You're able to control so much in the economy. You're controlling the values of currencies and the values of stocks and bonds. You're able to control so much through the price of interest rates by setting the price of interest rates. And this power is awarded to a tiny central banking elite. And we're just supposed to trust them to be good guys. We're supposed to trust them to be right. And yet they rarely are. They rarely are. 9 months before the Great Recession kicked off, Ben Bernanke said, we don't forecast a recession. We don't see anything coming. 9 months before. So it was just yesterday. Now the Federal Reserve, under the leadership of Janet Yellen, again, I don't want to pick on Janet Yellen or any other single individual. It's really the institution itself. The Federal Reserve as an institution shouldn't exist. I'm sure they're all very nice people, and I'm sure they're all very smart people and intelligent people. But the institution itself shouldn't exist. There shouldn't be a handful of people sitting in a room making decisions that affect literally almost every single person on the planet. The US dollar is the world's dominant reserve currency for now. And as it's the world's dominant reserve currency, it means that when a Chinese manufacturer does business with a Brazilian supplier, they do that deal in dollars. And so what happens to the dollar and the US banking system and the US economy matters. It matters to a guy who's buying turnips in Sri Lanka. It matters. It affects the lives of so many people, and it's awarded to just a tiny little unelected central banking elite. They have so much power, and they're not shy about using it. Since the Great Recession started, the Federal Reserve expanded its balance sheet from $800 billion to $4.5 trillion. This has massive implications on the global economy. And the entire world is just supposed to trust them to be good guys. Again, and they're not even elected. Everybody pretends they're living in some Republican democracy or Democratic republic. But really all we're electing are stooges because the guys who have the real power over the economy are not elected. In fact, most of them are actually appointed by the boards of directors of Federal Reserve banks, which, by the way, the majority of those guys are appointed by commercial banks. It's the Goldman Sachs and the J.P. Morgans and the Citis of the world that appoint the directors of Federal Reserve banks, which in turn appoint the people that end up on the Open Market Committee at the Federal Reserve who make decisions about interest rate policy. And we're just supposed to trust them to be smart guys. We're just supposed to trust them to be right. And they rarely are. So now just yesterday, the Fed decided now they're bullish on the economy, and as a result, they're going to discontinue their asset purchase program, which is known as quantitative easing. And let's be honest, 3 cheers for that. Quantitative easing was the most destructive economic program in Federal Reserve history. Again, they expanded their balance sheet by more than a factor of 5. This does not create credibility for the world's reserve currency. It was almost as if they were sending letters to every single person on the planet say, please stop using the dollar. You can't trust us with it. This is what we're going to do. We're going to just conflate it and print it until it has no value whatsoever. That's not the way that you inspire confidence and credibility in the system. It was so tremendously destructive. I think Tim Price, our colleague, who, by the way, runs Price Value International, great letter if you haven't checked it out, made a really great argument. On Monday, we published this on our site, and he said, people argue that quantitative easing has been a major success and that it's worked. And he said, it just depends on how you define success. If you define success as having brought interest rates down to basically zero, then yeah, sure, it's been successful. But does that actually help anybody? Does that help the average guy? Does interest rates being zero really actually benefit the average guy on the street? It benefits banks. It enables banks to get record profits. And what you're ultimately doing is helping people that are already extremely wealthy and own the vast majority of stocks and property and so forth because they see, the fine art market has had a bonanza. If you own some, Chagall or whatever, you've seen the value of that go through the roof. But for the average guy, what has it really done? There's still 9.3 million people unemployed in September 2014, just last month. This is according to the government's own data. That's up from 7.6 million before the Great Recession started. There's more than 7 million Americans working part-time that are looking for full-time work. Wages, adjusted for inflation, are well below where they were from even 15 years ago. What have zero interest rates done? They've made it to where consumer credit is once again at an all-time high. Consumer credit collapsed in 2009 when the Great Recession kicked off, when Lehman Brothers went under, and everybody was, again, fear and panic and so forth in the marketplace. And what happened? Suddenly everybody got responsible. People had to start paying down their debts. Net worth, net savings actually became positive in the United States because people had to say, we got to tighten our belts. We got to start saving. Now all that's completely gone away. Now, consumer credit has now exploded. It's an all-time high. People are getting into debt again at record levels, thanks to zero interest rates. Congratulations, Federal Reserve. U.S. debt, the debt of the U.S. government, has also reached a record high, $17.9 trillion. In fact, total debt worldwide has hit $100 trillion. Is this really beneficial? There are some folks that would argue that debt is a form of wealth. Because you could make the argument that one person's debt is another person's asset. If you loan me money, if you loan Simon Black some money, now I am in debt to you. I have debt. But that debt is your asset because you hold that on your balance sheet as an asset. I'm going to pay you back someday. I'm going to make interest payments to you. So you're going to get some monthly or quarterly or annual income from that, and someday I'm going to actually pay it back. So theoretically, that's supposed to be an asset. But here's why it's not. For one, interest rates are below the rate of inflation. Around the world, when you loan money to governments that have racked up more debt than any other governments in the history of the world, you're not going to get more than the rate of inflation. In many cases, if you go buy German bonds, you got to pay them rent. You have to pay them to loan them money. I'm sorry, but I have a hard time looking at that as an asset, as something that's actually going to benefit me. When I have to pay you to loan you money, that's not an asset. But more importantly, And by the way, it's the same thing in the United States. In the United States, on a tax-adjusted, inflation-adjusted basis, in France and Spain and so many places around the world, you can't generate more than the rate of inflation. Just about anywhere out there, even in your bank account. Corporate bonds. Junk bonds are yielding 5%. If you loan money to a company that people don't even expect to be in business in a couple of years, you're going to get 5%. You have to take huge risks just to be able to beat inflation. That's not really an asset. But more importantly, you have to look at who owns these assets anyways. The U.S. government, again, $17.9 trillion in debt. Who owns trillions upon trillions of that? The Federal Reserve. The Federal Reserve. And this is a huge difference because if you loan me money, you're loaning me money out of your own savings. You worked for that money, right? You worked, you saved, and then you loaned it to me as an investment because you look at it and say, hey, if I loan money to Simon Black, I'm going to get paid more than if this money just sits in my bank account. Okay, so that's an investment for you. But what is and you had to work. That's investment capital for you. You had to save to get that money. What does the Fed do? The Fed ends up loaning money to the United States through an absurd process where they give money to commercial banks who buy bonds from the U.S. government, and it makes its way onto the Federal Reserve balance sheet. So the Federal Reserve is sitting on trillions of dollars of U.S. debt, but what do they have to do? Nothing. Nothing. This little cadre, this committee gets together and makes a decision and say, oh, let's create money. Let's expand the money supply. So what do? They just print money. They didn't actually even print money. It's not a physical process. They just conjure, so make a few clicks with their mouse on a computer, and poof, now there's billions of dollars more, and they can buy U.S. government bonds with those billions of dollars, and they sit on their balance sheet. There was no work done. There's no productivity. They didn't make anything. They didn't do anything. They didn't save anything. They just created it. And in creating money, they took that and enabled the U.S. government to go deeper into debt. That is not wealth. There was no wealth that was created. You don't conjure wealth out of thin air like that. And of course, that's what most central banks do. And it enables this process when you enable a process by which you can conjure money out of thin air and not have to do anything for it, and sprinkle it around the system and enable everybody else, all of the players in the system, consumers, businesses, governments, to be able to go into debt. And it has completely broken the system. I wrote something earlier this week about agriculture, and it's a great story. The agricultural revolution changed everything for human civilization. Before that happened, human beings were running around hunting and gathering and killing animals, and you can imagine taking huge risks in doing that. Huge risks, and going and stalking animals with their prehistoric weapons and their blunt objects, and gathering berries, and who knows which of those is going to kill. Who knows what they're eating out there? Some of them are going to be really dangerous, and there's animals and everything. And suddenly they learned how to plant stuff. They learned how to actually cultivate the earth. They learned that if they put seeds in the ground and they gave it some water and it rained, that they could actually that the earth would actually provide for them. That they could grow things. And for the first time ever, they realized that they could produce more than they could consume. Instead of having to spend all day hunting and fishing and gathering just to eat that day, and then the next day they'd have to get up and do it again and again and again. They spent their whole lives hunting and fishing and gathering, and if they didn't do it that day, then they didn't eat. And suddenly, for the first time ever, they could say, you know what? I can cultivate more land than I could, and generate more crops than I could possibly eat myself. And I could take the rest of it, I could set it aside for the winter. Or even more, I could take the surplus and I could trade it for something. And this was human civilization's really first experience with savings on a mass scale. That's fundamentally what savings really was the excess. It was the difference between what you produced and what you consumed. And if you produced more than you consumed, then you had savings. And suddenly with that savings, you say, you know what? I have so much food saved up. I don't have to work the land next season. Or I can trade this for something else that I wasn't able to do. I was spending my time working the land, and I could trade my excess for something else, like a house or a wheel or more animals or whatever. And suddenly people could do that on a larger scale. Suddenly they could actually then take time because they had so much savings. They could take time and pursue other things. They could produce, they could build additions to their house, and they could go out and study things and study the stars and study science and try and figure out how things worked. And that's how civilization was actually developed. Human civilization was able to flourish because they had savings, and they could draw on that pool of savings and do other things, or use it to trade with other civilizations and other societies that were producing other things. That's how human civilization began to flourish. It was based on a very simple premise: you produce more than you consume. And that's where wealth is created. The difference between what you produce and what you consume. And that is completely broken today. Today, wealth is viewed as money creation when central bankers conjure money out of thin air and when you go into debt. And that system is completely broken. We have gone far, far, far away from the basic premise, the basic fundamentals that created human civilization and why we have all this stuff that we have today. That simple premise of producing more than you consume, and it's completely and totally broken. Now we just print money. We go into debt, and then everybody ignores it. Everybody ignores the reality of what happens because the high priests, who have an interminable track record of getting it wrong, tell us that it's all good. Tell us that everything's fine. It's so good that we're going to end our completely destructive program. And of course, that's the major irony, is the program was quantitative easing was so destructive, and they should never have started to begin with. The Fed itself should never have been created to begin with. They should never have gotten the opportunity to conjure trillions of dollars out of thin air. And so they finally ended the program. But they ended the program for the wrong reasons. They should have ended the program because it was destructive. And how great would it be for somebody at the Fed to say, "Oh, this has been completely destructive. It hasn't done anything for the average guy out there on the street. We've completely ruined people's lives all over the world with quantitative easing, and at the same time, it's benefited a tiny handful of people who are already extraordinarily wealthy. We should have never started this to begin with." But that's not what they say. Instead, they say, "Oh, we're going to end this because everything is so good." Bear in mind, these are the people that consistently get it wrong. I was just in the United States about a week and a half ago. And again, my view on this is sort of as an outsider. I don't live in the U.S. I grew up there, so obviously I have a very deep and fundamental understanding. But now it's that analogy I always make. It's, I was just remarking this the other day. My sister had a child about a year ago. She sent me some photos, and I looked at it. I said, as you would say, as the uncle, to say, "Wow, I can't believe how big she's gotten." It was the last time I saw her. She was an infant. And it's the exact same thing, because I don't notice those day-to-day subtle changes. All I see are these snapshots in time. Months go by, a year goes by, and suddenly I go, "Holy cow, I can't believe how big she's gotten." When I don't live in the U.S., and I come back after months and months and months away, I notice these acute changes very quickly, which is different than people that live there, because you can get dulled to the changes that happen on a day-to-day basis. And I look at it, and it's I ignore a lot of economic statistics. GDP is one of these things. I look at it as completely irrelevant. The economists will sit around and say, "Oh, GDP was this and GDP was that, and the growth rate was this and the growth rate was that." How do you really know? Okay, I mean, they say the GDP is $14-15 trillion. That's such an extraordinarily large number. How does anybody really actually know? Yes, there's an entire science behind that. They call it econometrics. I would point to people to say that at one point racial science was actually considered a science, where people would measure the slopes of people's foreheads of different ethnicities and use that data to conclude that certain races were inferior or superior to other races. It was utterly absurd. So yes, econometrics is a science, just like the ethnic sciences were. I don't put a lot of credibility behind this stuff. Bill Gates has no idea really what he's worth. In general, it's very hard for anybody to really know what they're worth, because asset prices go up and down on a daily basis. I mean, if you're an entrepreneur, how do you really know how much you're worth? For example, you own a private business. I mean, it's very difficult to actually assign values to these sorts of things. And if somebody like Bill Gates doesn't know what he's worth, and he's worth somewhere in the tens of billions, how can the U.S. government know what the U.S. economy is in the tens of trillions? I mean, it's literally an order of magnitude of over 1,000 times. They can't possibly have any idea. Individuals don't know, and it's not like anybody really cares. On an annual basis, do most people actually pull out all of their statements and try and actually, my net worth this year went up by $4,000, and I mean, no, that's not how people actually look at their personal financial gain. What do most people look at? What are the things that are important to people? When you look at your financial situation, what do people look at? They look at how much cash do you have in the bank? How much cash or liquid assets do you have in the bank? How much long-term security do you have? Are you in debt up to your eyeballs? Do you have money socked away for the future? Are you healthy? And what's your standard of living? How well are you living? Are your kids going to good schools? Do you live in a good neighborhood, in a comfortable home? Do you have reliable transportation? Are you eating good food? Or are you eating this crap they sell in the grocery store that's chock full of high fructose corn syrup and partially hydrogenated soybean oil and yellow 5 and whatever else they put in there? Or are you eating actually good, wholesome, organic food? Those are really the three things that are important: that cash and liquid assets that you have available, long-term security, and standard of living. I would argue that standard of living in the United States is extremely high, as it is in Western Europe and a lot of very well-developed places in the world. I was driving around with a friend of mine. He's got a very nice Corvette, and we had the top down, and we were cruising around, and looking around these neighborhoods in suburban New York. It's really nice. It's really nice. I mean, big houses and nice cars and so forth, and it's a very enviable lifestyle, I think, for a lot of people around the world. That's the stuff people see when they turn on American movies and American television. They see that lifestyle, and there's a Starbucks on every corner, and people say, I want that. I want that. But you look at some of these other things, cash in the bank, liquid security. Do people have that, a lot of liquid assets? Do they have that long-term security? Do they have a lot of money socked away for retirement? I would argue no. Most people are entirely dependent on a bankrupt social program known as Social Security, which is clearly in the red. Debt levels, of course, are increasing. This is another major factor for long-term security. But I think if you look at the macro data, look at the U.S. government's own numbers, does the U.S. government have cash in the bank? No. They hardly have any cash in the bank. In fact, there have been times when a lot of the big tech companies, when Apple and Google have had more money in the bank than the U.S. government. Does the U.S. government have long-term security? No. They have no chance of paying off their debt, ever. Ever. They're borrowing money to pay interest on the money they've already borrowed. They've long passed the point of no return. And does the U.S. government have standard of living? Well, I suppose they have very high standard of living. They've got all the great stuff. They've got fighter jets and drones and body scanners and all that sort of stuff. I suppose that's the government equivalent of standard of living. But you got one out of these three, and you look at these three factors and say, what does GDP, net worth really matter when you're looking at these factors? And that's the stuff that's really missing. That's my view on it when I actually look at the economy. And so when they talk about the economy, they say, the growth is this and growth is that. And I look at it and say, does the growth actually really matter? That's the one statistic that people pay attention to. What is GDP growth? I would actually argue that GDP growth is irrelevant. In the same way, on an inflation-adjusted, population-adjusted basis, if you reach a certain level where people have security and there's cash in the bank and standard of living and so forth, if you're that way as an individual, if you say, I'm living very well, I'm comfortable, I'm very comfortable with my families, we have long-term security, we've got a lot of money, I could drop dead, my family's going to live very well for the rest of its life, we've got a lot of cash in the bank, we're well invested, we feel safe, we feel comfortable. Are you really going to be so concerned about growing? Do you have to have more and greater and bigger? Or at some point are you going to switch and say, I think I'm going to try and make an adjustment. I'm going to want to spend more time with my family. I'm going to want to pursue the things that I've always wanted to do. I'm going to get out of the rat race, and I'm going to do the stuff I've always wanted to do in my life. Or you're going to say, I've finally reached everywhere that I want to be, and I'm going to spend the rest of my life doing stuff that I hate so I can have more. My argument is that growth is not the end-all, be-all. And I think on an individual basis, our human nature is to say that growth, economic growth, financial growth really isn't everything. It's not the end-all be-all, and yet it's the only real economic statistic that people pay attention to, is that quantitative GDP growth, and completely ignoring the qualitative factors, long-term security and standard of living and so forth. But I think the probably bigger issue, because none of this stuff is really being looked at, and again, the high priests and the who drive the economic system are just looking at those primary figures: growth, growth, growth. And they look at growth through employment, and they completely ignore the qualitative factors. Say, oh, employment's better. Yeah, because everybody's got a part-time job. Because there's 7 million Americans working part-time who can't find full-time work. There's still 9.3 million people unemployed. But they're just looking at one single number, and they're ignoring all the qualitative factors entirely. And they do a really great job sort of whitewashing the situation and letting people think that it's all good. And there's a lot of things, for people to get excited about, because stocks are at all-time highs, and they've seen their property values go up and so forth. My view is that when I look around in the U.S., I see 2006, 2005 all over again. And it's this attitude that asset prices always go up, that stocks always go up, and bonds always go up, and property prices going up, and the fine art market always goes up, and all these things, all these sort of conventional asset classes always rise, and all of these are basically at all-time highs all at the same time. That's not normal, by the way. It's not normal for a property market and a bond market and a stock market and a collectibles market and all these things all at the same time to be at all-time highs. That is not normal. That's a massive canary in the coal mine right there, screaming that there's something wrong with the system. But it's widely ignored, just like it was in 2005 and 2006 when guys like Peter Schiff, I love Peter, he's a friend, and I will always respect him for when he went out on TV and he went on TV in 2006 and say, this economy's in a bubble and it's all phony and this is paper money and they've just printed all this phony wealth and it's not real wealth. And he was laughed at. He was laughed at on TV over and over again. And he would go on CNBC on these panels, it'd be 8 other people laughing at Peter. And of course he turned out to be right because it's all paper. Nobody wanted to hear it. Nobody wanted to hear it. And nobody wants to hear it today. It's much easier to just believe that asset prices always go up, that stocks are always going to go up. There was an economist, I think his name was Irving Fisher, right before the stock market crashed in October 1929. He said something to the effect of, I believe we've reached a plateau of permanently high stock prices. These are the sorts of things that always happen. This is, now you've got individuals plunging into the stock market now in record numbers. Because, of course, that's the hot thing to do. And stock markets always go up. So, of course, this is what people want to do with their money. And these are dangerous things to be doing. The central bankers have completely broken capital markets. They've completely broken the economy. They've completely broken the fundamentals of human civilization. It's not about producing more than you consume now. It's about creating money. It's about going into debt. It's about making very risky investments because, of course, interest rates on an inflation-adjusted basis are negative. And it's created asset bubbles all over the world, particularly in the United States. On a Shiller price-earnings basis, the U.S. is one of the most overvalued countries in the world in terms of its stock values. Denmark is slightly more overvalued than the United States. And these are all based on the prognostications of the high priests who consistently get it wrong. And that's where we're at right now. I view this as 2005, 2006 all over again. Asset prices will always go up. People are completely oblivious. Nobody wants to hear it. Everybody says that it's all good, and the talking heads are telling you, buy this, buy that, and so forth. And there's risk there. And it's a very hard decision, I think, for people to say, okay, well, what am I supposed to do? I've got savings, I've got money, what am I supposed to do? Because if I do nothing, I'm going to lose. If I do something, I'm taking risks. But if I don't invest in the market, and maybe the market continues to go up 15, 20% a year for the next couple of years, then I'm going to miss out on that. What am I supposed to do? It's very hard. And there's a great argument, and people are looking at all the money that's been created, and they're saying, oh, maybe there's going to be massive inflation for this. And other people say, oh, there's going to be massive deflation from this. Look, the system is broken. Paper's out. And there's certainly a lot of evidence for both inflation and deflation. But I think debating it is like holding a beauty pageant for who your executioner is going to be. The idea is you want to do what makes sense in any one of these scenarios. What are the investments that make sense if this broken system limps along for even a couple more years? Where the stock markets keep going up and bond markets keep going up and property markets keep going up. And maybe you don't want to miss out on that. So what are the investments that you can make that make sense in that environment? But simultaneously, what are the investments that make sense in an inflationary scenario where certain asset prices go up because they've printed so much money and there's been a loss of confidence in the currency, which, by the way, is already happening. We talk about this, usually at least one article a week in Sovereign Man about, the continued decline of the dollar. It's happening. This isn't conjecture. This isn't conspiracy theory. This isn't some wild and crazy prediction from Simon Black. This is evidence. This is happening. The Chinese have led the creation of multiple supranational banks to compete directly with the IMF and the World Bank. The renminbi is now being freed up. Just early this week, they said, we're going to, we just signed a deal with Singapore, and we're going to make the renminbi fully convertible with a Sing dollar effective tomorrow. Instantly. I mean, obviously, that deal was in the works for a long time. They're already doing this. They're making it convertible with the euro. They've got trade settlement agreements where they actually settle trade for certain commodities directly in renminbi. They're making currency swap agreements with central banks. You've got governments and central banks that are holding renminbi as reserve. You've got the government of the UK now has issued a government bond of actually significant value, significant size, denominated in renminbi. It's happening. It's happening. You can see SWIFT, actually, the Society for Worldwide Interbank Financial Telecommunications, actually produces a monthly renminbi report. And the renminbi report, just since January of last year, since January 2013 to today, there's been an astonishing rate of increase of the use of renminbi in international transactions. It's incredible. Right now, it's in its completely nascent. It's in its infancy. It's in its infancy. The U.S. dollar is still far and away, the most popular currency in the world. The euro, far and away, the second most popular currency in the world. And the renminbi is distant to all those. But it's happening. It's growing every month. It's growing. It's getting more and more and more. The dollar is becoming increasingly, an endangered species in the international reserve world. There's going to come a time when it's when there's a direct competition with the renminbi, and it loses substantial market share. That's something that could create substantial inflation in the United States. So what do you do? Where do you put your money in that situation? But the third point is, what do you do? Where do you put your money? How do you invest in a situation where there's deflation, when the bond market collapses and suddenly prices fall? Asset prices fall. You've got stocks stock prices that fall. I mean, we saw this in 2008 after Lehman collapsed, and the stock market went down to the Dow went down to 6,000 and change, and there was widespread asset price deflation all over the world. Is there anything that really makes sense for all of these scenarios? What do you do if the system holds up? What do you do if there's inflation? What do you do if there's deflation? Is there anything that you can do that actually makes sense for all of these? I would argue that certain real assets make actually a lot of sense. Buying productive land can do very well in any of those scenarios. If this continues, then property prices should do well. If there's inflation, property prices will continue to do well. If there's deflation, one of the things that makes a lot of sense in deflationary scenarios is income. If you have anything that actually productive assets that produce income, then those can do very well in deflation. I think also valuable, well-run, well-managed businesses, if you can buy those for really less than their asset values, undervalued, deep value businesses, productive, well-run, well-managed businesses, whether they're public on the stock market or private businesses. I'm a big fan of investing in private companies. You can usually find a lot of really significant value in private companies. Companies that are they're obviously up and coming, that have substantial cash flow potential, down the road in the future. You can buy in early and get huge value on those. These are the sorts of things that make a lot of sense. I think as well, looking for yield opportunities. These are typically private yield opportunities where you can obtain superior yield. You can generate 5, 10, 15% returns that are secured generally at generous margins by valuable collateral that you would actually like to own. We did a deal. We've got one of our publications, Sovereign Man Private Investor. We did a deal with a company that was paying 15% in 6 months, backed by the assets of this company. And this is a company that was doing $130, $150 million a year in revenue. Was actually is now turning a very nice profit. And secured by the assets of this business. I mean, that was, in a way, kind of a no-brainer to be able to get 15% in 6 months secured by assets of a productive business. These kinds of opportunities are out there. And again, when you're buying income, when you're buying a 15% return secured by assets of a business or secured by some kind of asset that you'd like to own anyhow, or where there's substantial margin. I know guys that are doing this deal, collateralized assets, where they're getting basically $2 or $3 in collateral for every dollar that they loan, and they're getting 12, 15%. And if you're an SMPI investor, we'll be talking about this very soon. These kinds of deals are actually out there, and these are things that make sense in any of those scenarios. You're not going to be worse off because you're getting a 15% rate of return. It's hard to imagine that's going to hurt you. In an inflationary scenario, again, it continues to make sense. In a deflationary scenario, it makes sense because now you're obtaining income and you're secured by assets and so forth that are actually going to be worth something, even in a deflationary scenario. Particularly if you have a great margin, if you have $3 in collateral for every $1 that you loan. In that case, then the collateral could actually, the value of the collateral could go down by 66%, and you still actually be positive. Your collateral will actually be positive. So. These are all things that make sense. Real assets, I think private, well-run, well-managed businesses or publicly traded equities that are trading for far less than their book value. These are scenarios that make a lot of sense that really work in any one of these situations, deflation, inflation, or even a continuance of this absurd and broken system that we're living in right now. I think we should probably go ahead and stop it from there. I really appreciate your time and attention today. There's a couple of folks, actually, I hope to be interviewing very shortly. We'll be talking to you again next week. So thanks again. Thanks very much. Thanks for listening. Talk to you again soon.